In our recap, we discussed the definition of financial accounting and the types of business entities. We also looked at the users of financial accounting information and what makes information useful. We also defined the scope of financial accounting and its objectives as follows. So we defined accounting according to the CIMA definition. Accounting was defined as identifying, measuring, recording, summarizing of economic variables, and finally communicating them to the end users. So we also talked about the users being two, the internal users and external users of financial accounting information. Internal users, we described the employees, the trade unions, the managers. We also talked about external users like the shareholders, the journalists, the external auditors, as well as government. And so we looked at accounting as being a process, a step-by-step procedure, which is defined by existing concepts. These are called accounting concepts. So these accounting concepts talked about ISAS 1 up to 27. So we also talked about the different types of businesses, starting from a sole trader, who is a one-man business owner, who provides all the skills and maintains the records of the business. We also talked about a partnership where two or more merge to pool their resources and their skill. In the company, which is a corporate entity under law, where members called shareholders, these members are separate from the business. And so we define the two types of limited companies as being private and public limited companies. Private end with LTD, which is limited, whereas public end with PLC, which means public limited company. We also looked at the users of accounting information that I've already talked about. So we also looked at the qualities of good accounting information to say it must be relevant, meaning it must be connected to what the user wants. It must be reliable, means it has to be depended upon such that external auditors may examine it by auditing it and must be free from error. It must be comparable, meaning people must be able to judge to familiar or similar accounts in terms of size and nature of the business. It must be understandable, meaning every user must at least not find any difficulties in interpreting it. It must be complete, meaning it must be prepared with all footnotes that are needed so that whomsoever is reading those financial statements must not look elsewhere to have a full understanding. It must be objective, meaning it must be free from bias. It also must be timely in the sense that it must be required at the time when it is needed. So we have periodicity concept, which says it must be periodically produced at the end of a particular period. We also looked at a glossary of terms. We talked about items that we will use. We talked about what assets are, what liabilities are, what expenses are. In our previous session, I said assets are simply what the business owns. Liabilities are simply what we owe. Amount that we use to start a business is called equity. And specifically, owner's equity is simply what the owner puts in a business. So we went further on to enlist financial statements, the balance sheet, and discuss what is involved in each of them. So briefly, we described what income is, what expenditure is, what an income statement is, and a balance sheet. So to start with, we mentioned to say that financial statements are simply documents that are prepared to show the performance of a business or the state of the position of an organization. So the statements that we call the income statement and the balance sheet. Now, each of these have the following variables. We talked about assets. Assets are being what the business owns. and these ones must be in monetary value using the monetary concept. So the types of assets were enlisted as follows. We talked about current assets and non-current assets. Current assets are simply called current assets because they are in a temporal state. These ones change in nature over time within a period of a year and below. The types of current assets we talked about are entered in order of liquidity. We have cash at hand, which is the most available at the office, and cash at bank, which is money held at the business bank account. We talked about short-term investments, which are monies that the business may have that are invested in other businesses. We talked about prepayments, which are amounts paid in advance. Those are assets. So the business has not yet enjoyed the benefit of them. So that is still our money. We talked about receivables. These are called debtors. These are amounts owing to the business by credit customers. We know businesses engage in a lot of credit transactions. So that is our money. And finally, we spoke about inventory, which is meaning the stock of goods meant for sale. Somebody asks, suppose we have cars that we are selling. Is that called inventory? Yes, as long as it is meant for sale. But if it's meant for use in the business, it's called a fixed asset. We also looked at the non-current assets, which sometimes are called fixed assets or capital assets. These ones are long-term entities of a business that are used to generate income on a long-term basis. So we have what we call tangible and non-tangible assets. We have land, buildings, machinery, fittings, and fixtures. These ones are tangible. We have goodwill, which is a non-current asset. It is an asset in the sense that it adds for a long term. A good name to a business is a long-term investment, which is called an intangible asset. We also went to liabilities. We said sometimes a business may owe other businesses because we engage in credit transactions. So the debts are called trade payables or our creditors. So these represent the business obligation to transfer an economic benefit to a third party. Even these are classified into two. We talked about the current liabilities and also the non-current liabilities. The current liabilities are amounts that are due within a year. Examples are trade creditors. These are suppliers who the business owes money for goods they supply to us on credit. We also have accrued expenses, which simply represent the bills of expenses for services that the business enjoyed but did not pay for them. For instance, salaries, we enjoyed the service of our employees, but we did not pay for them. Maybe water bills, those are accrued expenses. We also have the bank overdraft, which is simply a short-term borrowing payable on demand, which a business usually is allowed to overdraw more than what a bank account holds. So this is called an overdraft. We also have loans that are payable within a year and taxation payable. All these are called current liabilities. Non-current liabilities are long-term debts that a company may need to repay over a long period of time. We talked about examples of long-term loans. These are bank loans that cannot be paid within a year. A mortgage, which is simply a loan issued for capital expenditure, specifically for some property that a bank may give that should be paid within a period that is stipulated. And a debenture, these are securities issued by limited companies at a fixed rate of interest, and they're repayable on an agreed terms. They have no collateral. I had mentioned this in the previous class. So what is the difference between the tangible and intangible assets? I may ask, what is the difference between tangible and intangible assets?
Yeah, we have got we say non-tangible assets, for example, goodwill, and then tangible assets depends, can be current or fixed.
Exactly. So the non-current assets are actually fixed assets. All right. So we have tangible and intangible non-current assets. The tangible ones, we can touch them. Non-tangible or intangible are things that we cannot touch, but they're part of the company's what? Asset, like a good name. So question number 2, let's categorize the following as non-current, current assets, non-current, or current liabilities. Let's start with shares in Kamui Cement Limited, intended to be held on a long term. What type of entity or element is that? Machinery,
Non-current liabilities.
non-current liabilities. Machinery used in production,
Current, which is under fixed
okay, current,
asset. It's a fixed
non-current.
asset.
It's a non-current asset, yes. Non-current means fixed. Inventory, goods for resale.
Non-current.
Non-current. Bank overdraft.
Liability.
What kind of liability? It's a current liability. Okay. Mortgage loan.
Non-current.
Non-current. Trade payables.
Current liability.
Current liabilities. Trade receivables.
Current liability.
Current liabilities. Try again. Trade receivables.
It's this asset, this non-current asset.
Try again. Last try. These are current.
These are current assets.
These are current assets, yes. Then goodwill.
Non-current asset.
Non-current asset.
Intangible.
The intangible,
Non-current.
yes. Then we go to rent paid in advance by business.
These are prepayments. These are it's a non-current asset.
Non-current asset, they are prepayments about rent paid in advance to the business.
Mr. Collins, the one rent paid in advance by the business, it's not non-current. It's not non-current.
It's a
asset?
current. It's a current asset. These are prepayments.
Okay, it's a current asset.
How about
Then
rent paid in advance to the businesses? Means we have property somewhere, then somebody
Also,
paid us in advance.
it's also a current. It's also a current asset.
In what category? People pay us in advance.
It's income. It's income for the company.
Read it carefully. People paid us in advance money. They prepaid us, not us paying us. So we are holding people's money. They haven't enjoyed.
So then it's a liability.
Yes, it's a liability.
It's a current liability.
Current liability. Okay. Accrued income to the business.
liability.
To the business. There's accrued income by the business and to the business.
Oh,
It's an asset.
current.
It's an asset, current asset.
Okay, then by the business.
It's a
It's
liability.
a current liability.
Okay, excellent. So the format of the balance sheet is as follows. Our assets must be equal to capital plus liabilities. So we have a vertical format of the balance sheet where assets must be equal to current capital plus the liability. Capital is the amount we use to start a business. So this is a vertical format. So when we start with assets, we have the non-current assets or the fixed assets here, we get the dot. Then the current assets, non-current, intangible non-current assets, we get the dot. Then we can also add the long-term investments, which is a share in another company. Then we add our current assets here. So the total here will give us what? The total assets. So this is giving us letter A, assets. Then financed by capital. So we start with capital at start, add the net profit. If there's a loss, we subtract the loss. Then we subtract drawings. What are drawings? These are monies that we withdraw from a business for personal use. So this is what? Our capital. Then we add our non-current liabilities and we add our current liabilities. So the total here will be our equity and liabilities. So our statement must be verified that assets must be equal to what? Capital as liabilities. Okay. So this is what we're going to basically align. So for now, I need you to understand the formats that are there. All right, so we have the following information here. So what we want is to prepare a balance sheet using this information. Let's balance it up. So we have capital. So let's use the format that I'm talking about together. So let's start with what? What is on top? The fixed assets. So which fixed assets are there? Let's identify the fixed assets here. Which ones are there? Identify the fixed assets.
Fixed.
We have got the motor vehicle.
The motor vehicle, correct.
We have got also premises.
Premises, correct. All right. Then let's identify the current assets. Which current assets do we have?
The current assets.
Mm-hmm.
We have got cash in hand.
Cash in hand, correct.
We have got receivables.
Receivables, excellent.
What of closing inventory?
Insurance prepaid, yes. Closing inventory, correct.
Profit during the profits.
Profit, is it right?
What of profit made during the?
Profit can't stand.
Okay.
Remember, I needed you to, profit is under the capital. We add it to the capital at start. Let's drawings. Okay, so let's go back to the format maybe again for the balance sheet. We start with the fixed assets, which have the tangible and the non-tangible. We total them there. And also the long-term investments, if any, we have there. Then we go to the current assets, which have inventory, receivables, prepayments, cash in hand. Then we total these ones. So we have the total assets together. So we have our A already here. Then it should be equal to capital. Capital comprises of capital at start, add net profit, less drawings, because drawings reduce the capital. Then we have the capital there here. Then plus liabilities, both the non-current and current liabilities together. So this figure here, when you add these two, should be equal to our total assets. So with this data here, to avoid wasting time, so our non-current assets, you are right, we have premises, fixtures, and fittings, the total is there. Then we go to the non-current assets, we have inventory, receivables, prepayments, and cash at hand, you total them. So this is our total assets that we have there. So we have A. So A should be equal to what? Capital. So capital at start of 7,000, add the net profit 8,000. If it was the net loss, we subtracted there, then less drawings. So our capital is there. Then current and non-current liabilities. A 5-year loan is a long term because more than A comes there. Non-current, we have payables, overdraft, tax payable, accrued expenses. We total them up there. So these make our liabilities. So this asset figure must be the same as when we add these two, capital plus liability. You must make mention that some of the variables here don't qualify to be in the balance sheet. So you need to be careful which one is supposed to be there and which one is not supposed to be there. Okay. Which one is supposed to be there and which one is not supposed to be there. So fortunately, everything was used in here. So this is how the format of the balance sheet must look like. So let's try this one again. We're given our statement to come up with a balance sheet. So which one's our assets? Fixed assets?
Land and buildings.
Land, correct. What else?
Motor vans.
Motor van. Where is motor van?
Down. It's down. Yes, it's somewhere there.
Fixtures and fittings.
Fixtures and fittings, correct. Then the current assets, which one do you have?
Inventory.
Inventory, correct. What else?
Cash at bank.
Cash at
Cash
bank,
bank.
Yes.
correct. Anything else?
Receivables.
Receivables.
Yes.
Mr. Duncan, sorry, Mr. Collins, the
Yes.
receivable. Yeah, sorry, I beg your pardon. Yeah,
Yes, please.
yes, receivables. This is the money that we are expecting from the people owing.
Yes. Receivables are debtors, people who are supposed to pay us. That is our money.
Okay.
All right. Yes, please. So that is our current assets. Then what do we go to? Finance by capital. So capital, we add what? Profit. Then we less what? Drawings. Okay, so we get our capital. Then we go to fixed asset, or long-term liabilities. Which ones are the long-term liabilities here?
The long-term mortgage.
Mortgage, correct. Anything else? If there's a long-term loan, we're gonna put there. Then which ones are current?
What of expenses not yet paid by business? Where do they fall?
Under what?
The current liabilities?
Current liabilities. Now that's where we're going. So we go to current liabilities. Which ones are current liabilities?
Expenses not yet paid.
This
Not
one,
yet.
this one was supposed to
No.
be under current what? Assets, yes. So
Current. Okay.
these are current liabilities. All right.
Yeah.
And what else is current liabilities? Our payables.
Payables.
Excellent. I'm glad we're moving together. So
Mr. Collins, excuse me.
yes, sir.
I can see two capitals there. So the last one, capital as at 1st January, where does it fall?
Okay, there are two capitals there. Capital introduced during the year and capital. So this is our capital. Then you can also add this one. It's also part of our equity. Both of them.
So capital introduced during the year, is it like, for, how would I put, like maybe to increase your goods, or more like expansion for the business, or during the course of the year you inject some more resources?
Yes, expansion, not goods, but expansion of the business, because you need to differentiate. There's what we call capital expenditure and revenue expenditure. Capital expenditure is when we're expanding the business or some shares have been bought, but revenue expenditure is an expense in the income statement, because when you're repairing fittings and fixtures, that one doesn't go to the balance sheet. It is part of the income. They're running expenses. If you are buying stationery, all those are running expenses. They don't affect the balance sheet. But things that are meant to stay, those ones are called capital expenditure. Very good question. All right.
Maybe before we proceed. Yeah. So we are supposed to add the 50 as well as the 5 and then is it the
then
5
add profit
and the 6
drawings.
also, and then the less by the drawings?
Yes.
Okay.
Then we are following. All right. So that is basically how the balance sheet looks like. Now I need us to go to understand our income statement, there's a few variables that we need to know. So in the income statement, the job of the income statement is to produce the net profit and the gross profit. So in bookkeeping, the income statement is called the trading profit and loss account. The trading account has a job of producing what? The gross profit. And the net profit account has a job of producing the net profit. So if we are going to subtract our income minus expenditure, what we get is called the what? The profit. So under the income statement, we have the concept which is called the accruals concept. This is a concept which says that when we're calculating profit or income, whether received or not, as long as they relate to that particular period of time, should be matched to the expenditure, whether it was paid or not during the year in which it relates. What this simply means is, if you haven't paid wages, but you've enjoyed, you need to add accruals. So if you were supposed to pay 10,000 and didn't pay them, charge it for that particular, because they worked for you. However, if you paid electricity for the following year, also you need to subtract it because you have not yet enjoyed that electricity. That is what accruals concept talks about. So you need to take note of that. Then, because the accruals concept is used in calculating profits, remember that cash is an asset, or profit is an income. So cash goes to the assets. Don't confuse it with that, with income. So we also have other things to note in the income statement, is that income is divided into two parts. There's a gross profit and the net profit. Gross profit is simply found by the sales. You subtract the cost of sales or the cost of goods sold. That's what gives us a gross profit. And also we have expenses that we need to take note of. Expenses also hold to what we call revenue expenditure. So we have expenses as follows. We have carriage inwards and carriage outwards. Carriage inwards is simply the expense that is incurred on bringing goods into the business. This one is a special kind of expense that is added to the purchases. So we add it to the purchases figure according to accountants because it is attached to the purchases. Even the customs duty, it is added to the purchases. All right. So the other expenses that must go to the profit and loss account are the salaries of workers, the rentals, the electricity, the carriage outwards. What's the difference between carriage outwards and carriage inwards? Carriage outwards is simply the selling and distribution expense that we incur for delivering goods to our customers. Carriage inwards is the expense that we incur for bringing goods into the business. All right. So we also have other income that a business may engage itself in. For instance, a business may have income from rentals if it's owning premises. It may also have a profit made from a sale of a fixed asset. That one you add to the gross profit. It may also have other income received from a discount received from suppliers. You add it to the gross profit, or the dividend received from other investments. Those ones are addable to our gross profit. However, we need to understand that there are three categories in which we can categorize our expenses. We have what we call the selling and distribution expenses, which include our commission to the sales staff, our salaries for the sales staff, traveling, entertainment for sales staff, marketing costs, advertising costs. All these are called selling and distribution expenses. These ones go to the profit and loss account. We also have what we call administrative expenses, which include salaries of general staff, rentals and rates, insurance, telephone, heating and lighting. These ones are examples of day-to-day running of a business. So these are part of what we call revenue expenditure. Then we also have financial expenses, which include interest on a loan, interest on a bank overdraft. However, you can mix these expenses the way you want, but I just needed you to understand that these are, in fact, part of the income statement. So let's look at a sample. For instance, we bought goods with 250. So when buying the goods, the transport costed us 20 kwacha to bring them into the premises. So this is called carriage inwards. The same goods, we sold them for 450 kwacha. Then we also paid an assistant a fixed salary of 55 kwacha. So we asked, how do we come up with the gross profit? How do we come up with the net profit? So simple, gross profit is calculated as follows. We start with the sales. That asset which we bought, which was costing 250, we sold it at 450. So this is the sales we made. Then we subtract the cost of sales. What was the expenditure that we spent on buying those goods that we sold at a profit? We bought them at 250. We brought them into the business at 20 kwacha transport. So the total cost of bringing this was actually 270. So when you subtract 270 from 450, what we get is called our gross profit. Now, net profit is simply, even on your pay slip, what you get after all expenses are deducted. So our profit is 180. So the salary which was paid for this worker who works for us, which is 55 kwacha. So whatever remain is our net, it's our take home. So that is just a basic analysis of how our income statement must look like. So this is sales, we subtract the cost of sales, we have purchases, carriage inwards, we get there, then we get the gross profit. Then we subtract all expenses that we have. At this point, if we had other income that we needed to add, for instance, rent receivable, reduction in bad debts. By the way, a bad debt is simply in Congole that was supposed to be paid to us and we write it off. So we call it a bad debt. If we overstated it and we received more money, we call that a reduction in bad debt. We can add it to our gross profit. Anyway, much of what I'm talking about may sound jargon for now, but I will explain it properly. You will be listening to me passively at the moment because I'm supposed to teach this 3 times so that you get to understand. You enjoy this very much. I'm just trying to give you a preamble of what I'm going to teach over the weekend so that we now are able to balance up a balance sheet and do the adjustments of each and every entry that we're going to have for an income statement. So this,
Mr. Collins, a quick one. How do you deal with discounts?
So there are 2 types of discounts. There's discount received and discount allowed. Discount allowed is where we as a business allow an entity to get this. So we're making a loss under sales and distribution. So that is an expense which we charge. But if we receive a discount, we're gaining. So that is a gain that we add to our gross profit because it is increasing on our income. So these are 2 different things. Received is a gain, allowed is an expense. We also have returns in and returns out. So we have what we call purchases returns and sales returns. So purchases returns occurs when we discover that the goods that we had were either broken or wrongly sent. So we reduce the purchases figure by subtracting the purchases returns to get our net purchases. Same with our sales. We could have sold to our clients, but they discovered that the goods were not okay. So we get our net sales or sales turnover by subtracting from the sales figure the returns that we had. So these are the adjustments that you need to understand that will give us a format, general format of an income statement. So when we have our sales, we remove the sales returns. What we get is the sales turnover. We'll put it here. Then we go to the cost of sales. Cost of sales, we start with opening stock. Then we have purchases. We subtract purchases returns if there are any. So we get our net purchases. So remember, to the purchases figure, you can add carriage inwards because the transport of bringing the goods into the business, or the customs duty. This adds the purchases figure. So this net purchases, when we add these figures there, they will give us the total cost of purchases here. So when we add our opening inventory plus our cost of purchases, what we're going to get is the total cost of the inventory we have. Then we subtract what remained with at the end of the year, which is called closing stock. The figure we get is what we call the cost of sales. Now, cost of sales, like I mentioned, is what we subtract from our sales to get the gross profit. So from the sales turnover, we subtract the cost of sales. This will give us the gross profit or loss. Then if we have any other income like discount received, commission received, rentals received, these ones will add to our income. So this becomes our new gross profit or our new income. Then to this income, we're going to subtract the expenses that we may have. What kind of expenses do we have? We have carriage outwards, the transport for transporting our goods. We can add the discount received, discount allowed, because we're losing out. The sales and the salaries and wages, these are administrative costs, the rent, the bad debts, when we decide to write off a debt, the depreciation, light and heating. So collectively, all these are called what? Revenue expenditure, not capital expenditure. So you don't put in a purchase of a vehicle here because that is not a revenue item or element. These are operational costs. So when you total them up, these are total expenses which you subtract from our total gross profit. So the difference between these two is what we call our net profit. Net profit will now take us to what we call the balance sheet. So we end here for today. I'll repeat this session, but please read loud. Read aloud in your free time, because this is where accounting starts. This is where accounting starts. Are there any questions?
Sir.
Yes,
Do
sir.
we have these notes?
No, you don't have these notes. I'll send them to the paid up group so that you access them. These are simplified notes.
Thank you.
Thank you.
All right.
Yeah, on the same one, these are the stuff that you are going to find in the pamphlets that you had talked about.
Yes. I've sent a pamphlet with for all of you. It's a free copy. Questions and answers for the FMA. You find these ones actually. This pamphlet that you use most of the questions from here. These notes. All right. Thank you so much. I'm still at the office. I need to go home. So
You have already sent?
I'll send